Thanks, Doug. I'm looking forward to a great discussion here in the Think Tank Exchange. Let's start off by, give us your background and some information around the company that you are at.
Sure. Thanks, Dan. And thanks everyone for taking the time to join us today. We'll try to make this a lively conversation. I promise not to sing. Doug Fincher. I'm a portfolio manager at a firm called Ionic Capital. We're a New York-based asset management firm that was founded in 2006. I've been here since 2012, and I've known the founders of the firm for longer than I care to admit. I've been working on Wall Street for 30 plus years in different capacities, managing money, allocating capital to funds, and directly managing assets. We're about a $4 billion firm, as I said, founded in 2006. And not to get too far in the weeds, but it is, I think, sort of interesting context. The two gentlemen that founded the firm have a pretty unique background, Dan Stone and Bart Baum. They had worked together at one of the premier hedge fund firms in the world called Ionic Capital Management. They were principals at the firm and equity owners, and the firm was acquired actually by JP Morgan in 2006 and still exists as a big component of the alternative asset business at JP Morgan. Kind of the way that JP actually got into the business was through the Highbridge purchase. Dan and Bart felt like it was a great opportunity for them to do something entrepreneurial, and fortunately they had equity capital from JP Morgan for the acquisition to start Ionic. Did really well in the financial crisis, 2008. I think that speaks to, maybe just to pause for a second. The firm's focus is relative value, arbitrage, long volatility, kind of tail risk strategy. So not conventional stocks and bonds. And, we tend to work with really large pension funds and endowments only on sort of completion solutions for them to help solve the diversification needs that they have relative to just owning traditional asset classes. How to increase returns, but also protect against different risks that they see. So, we've been in business for, it'll be 17 years, long time. And one of the things that, getting back to the topic, one of the things that we really became focused on as a firm after the pandemic was the risk of higher inflation, in the context of how we manage money. What's going to impact people's investments? Higher inflation, certainly. We say it really is the boogeyman for bonds and stocks. It affects your purchasing power, as Dan mentioned, but it also affects, simplistically, interest rates, borrowing costs. So we really started to be concerned about inflation and think about how we can incorporate inflation protection into the assets that we manage. And Dan Stone, one of the co-founders, really was adamant about the fact that if you look historically, once inflation starts, it's hard to stop. Now the pandemic created some unique supply imbalances, clearly, that caused those huge, the 9% CPI spikes. We recovered from that, but now it's that last mile is proven to be very, very tricky. So we purchased something called an inflation swap, which is a fixed floating swap. It's a clear derivative that is pure inflation. We own hundreds and hundreds of $1 million worth of swaps for our institutional clients. And the way it works is simplistically, Morgan Stanley is my counterparty. I pay them the fixed rate of inflation expectations, and I receive whatever inflation is. So if the expectation is 2.5, I'm paying 2.5. If inflation's running at 4, 5, 6, 7, 8, 9, I earn whatever that spread is. So it is the purest play on inflation and inflation expectations. And along with equity volatility strategies, rates vol, other instruments, we incorporated that inflation protection into our institutional funds. And we looked around the landscape in the listed market, which is not a market that we've really ever done much in. And so there really isn't anything out there that gives the average investor a way to access that inflation swap because it's a clear derivative. But I'll stop there, Dan. It's a little bit about kind of where we are coming at things right now.
Sure. So let's talk a little bit about conditions, right? Where we are right now. I think people are comfortable that inflation isn't going to rip again, but I agree with you. It's kind of like a Bronco. It could pop back up and surprise a lot of folks, and frankly, I think it will, because your point is right. It's hard to rein it in. What are you hearing? From whether it's a FOMC or whoever, right? What are your thoughts, broadly speaking, about conditions right now?
Well, I think there's so many folks out there that are, got a lot more visibility in the space than I do. I think a couple of quotes that I just listed this morning gives some context for what we think right now is higher for longer inflation, but also inflation volatility, inflation uncertainty, and it really drives. Rivian, we missed earnings. We blame it on higher interest rates. Everything kind of gets back to interest rates, not just cost to corporations, but the tax on individuals. The big solar companies. Oh, we're not selling solar arrays because people aren't buying them because interest rates are too high to finance it. Like everything gets back to rates and inflation. And a couple things I looked at today that were just astounding. Just literally the last 2 days. So Jefferson from the Fed today, he said the danger of easing too quickly. Barker, who's a voting member, she said much the same thing. The quote was, you have to worry that when the benefits from falling goods prices, when that cycle ends, you're going to be left with shelter and services that are higher than we'd like to see. That speaks to, the employment and services piece of the equation. JP Morgan's Kalanovic, who I think is very, very good, came out yesterday and actually said he thinks he's been pretty bearish, but he thinks stagflation is a real risk. You've got growth that's concentrated around AI. A lot of other areas of the market are struggling, and stagflation is the worst thing for stocks and bonds because it's higher interest rates, it's higher inflation, low growth, and persistently higher rates to fight that. A couple other things I thought were interesting. Bank of America does an institutional survey that a lot of people look at, and first on their list as a risk among investors was that inflation would see a surge again. And they had a great quote in a piece yesterday that I saw that I should have laughed, but they said there's one path to 2% inflation and 100 paths to 5% inflation. So there's a lot of very bright people out there that are saying a lot of things away from, we're going to get to the Fed's target. And where we are right now, to your point, Dan, about that, we're talking about that last mile. The Atlanta Fed tracks an index around sticky prices, and it's risen. We saw the CPI spike in January that I think, triggered the 50 bip move in the 10-year, and this big reversal from the what we call the Powell pivot in December, where we went from expecting 7 cuts to, depends who you talk to, 2 or 4. So I think the landscape has definitively changed. 10 years up 50 bips, expected rate, nowhere near the 160. So that's in the context of higher inflation. Then I think, just a tremendous amount of uncertainty around, look at the spectrum from stagflation to a resurgence in cost to services that are out of control. So the spectrum is really wide, and we're not saying that 5% or 6% inflation is what we expect, but we think it's a risk that is real that that we want to protect our portfolios from, and we think that investors really need to think about that from their own asset allocation programs.
Yeah, no, I agree with you. I think there's a lot of complacency again on people's bond portfolios or how they're investing in their bond portfolios, because well, wait, now I can lock in at 5% and I'll get 5% and that's a great return for me. But they're not considering what might happen if inflation pops back up and that bond portfolio goes down in value. And I think that's super important.
Yeah, I think that's right. And even, taking a step back, depending on, do you use super core, CPI? Inflation is somewhere between, let's say it's 3.5%. It could be as high as 4, 3 handle, but let's say it's even 2.5%. Let's say it's at the Fed's target. You got your 5% bond, take out your 2.5% inflation. You're actually only earning 2.5% as a best case, inflation adjusted, assuming the Fed gets inflation to where they want to be. So
gets it there. Yeah.
Before you even think about the risk to your 5, let's haircut the 5 to 2.5, and then maybe to your point about what the risks are to that 2.5.
Yeah, I think a lot of people fear for a recession. That's like what people tend to think about is, oh my God, I just don't want to go through a recession. But they underappreciate the implications of inflation if it is higher for longer, right? Because that has maybe more impact than a shallow recession. And we need a recession of some sort to clear the deck, I think, too.
Yeah, but I think back to your comment on the risk in bonds. So you think about soft landing, hard landing, no landing. We're kind of in this no landing zone. But a soft landing, you can unequivocally have inflation in a soft landing. We had oil spike to $100 or $95 in September, really kind of on nothing. Maybe some jawboning by OPEC. So, a lot of people took comfort in lower commodity prices. Oil can spike, inflation can stay elevated in a soft landing. The only thing that really, definitively is going to squash inflation is that hard landing, where you really impact demand. And back to your bond point. So what happens in a hard landing? Interest rates go lower, but to some, whatever degree you're going to go to, the economy is going to hit the skids. From a bond perspective, what happens? Well, credit spreads are going to widen as defaults go up. So as a bondholder, you'll make a little bit of money on the move lower in duration, assuming that the curve doesn't shift around like it has over the last couple of years, which is something else I don't think people appreciate. But your credit spreads on your corporate bond are going to widen. So, best case, maybe you offset some of the bleed in credit spreads with lower interest rates. But back to where we started it, that 5 becomes a 2.5. You take the 2.5 and you look at these different scenarios. I think it's why if you look at the ag over the last 2 years, it's barely moved. It certainly hasn't beat inflation. The ag's up something like 1.5%. So you're losing money on a bond portfolio, and you've taken on, degrees of risk. Obviously, treasuries, assuming we don't default, but our deficits, you could argue with that. But assuming that's the safest place to be, you go down the spectrum from investment grade bonds at a 90 over spread to high yield or private credit, some of the more speculative asset classes that are out there. You can lose a lot more on that deterioration in credit quality than you can make in the decline in interest rates. So I would 100% agree that people don't appreciate the risks in the bond market. And maybe an example, bringing it back to inflation, is if you look at tips. A lot of people bought tips after the pandemic to protect against inflation, and then they lament about how much money they lost. They didn't lose money because of tips. They lost money because, they owned a 10, 15, 20, 30-year tip, and the Fed raised interest rates 5%. So you got killed on the duration piece, even though tips, they did what they were supposed to do, absent that big move in duration. So if you don't the shortest dated tips, you did protect against inflation, and you didn't take on the duration risk that you took on. You bought a 30-year tip, you got killed just like if you had bought a 30-year corporate bond because of the movement in duration.
Yeah. So here we are today, and you and I were talking about this earlier about the Cisco bonds, and you're an institutional investor. Why is an institution, it may not be you guys, interested in a bond like a 40-year Cisco bond that's 125 basis points or so over the Treasury? It just seems like to me a loser's proposition.
Yeah, well, I think you've got to consider that it's part of an asset allocation. It's not all that they own in their defense. And if you're a big endowment, and you've got a 6% spend policy, you need to have some long duration assets. But I think simplistically, the thought is that the long end of the curve is going to come down. So maybe you can make a little bit of money, and they want to lock in that 5% long duration return in the spectrum of everything else. But on a standalone basis, as you and I are saying, you buy a 5% 30-year bond, the most you can make is 5% ex inflation. That's the most you can make.
Yeah.
If interest rates go up, you're going to lose money. If credit spreads widen, you're going to lose money. If inflation goes up, you're going to lose money. So your 5 can turn into something lower. And I think back to the big move post pandemic, I don't think, look, whether it was Silicon Valley Bank is the greatest example. Why did they go under? Because they own long duration assets, and they had to sell them. And no one that's been in investing in the markets in the last 30 years has ever seen a 500 basis point move in rates. And what that does to a 30-year bond, it takes it from par to 60. The losses are significant. And I'm not saying that, rates are going to go to 10%, but that's kind of what happened. And to your point about underestimating the duration risk, the credit risk, and the risk, and the embedded inflation decay that is going to impact the return there. And I think you had said it. You'd rather get to the Cisco analogy, where the stock yields 2.5. If I buy the stock, I've got my 2.5% yield. But if the stock goes up, I can make more money.
Yeah,
that bond, you can't make any more money than that. And I think that's it fits in a spectrum of portfolio, certainly, but you do have to think about the embedded risk in that. To your point.
So when you're thinking about a fixed income portfolio, let's just talk broadly about how tips can play a role in that, in general, and then we'll drill deeper into how CPII is constructed.
Sure. I think we had a client conversation yesterday, and we're just talking about short dated bills. The Fed cuts keep getting pushed out. Somebody wants to buy a 1-year bill at wherever it is, 5%, 5 and change percent. It's not bad. If you're away from, tax considerations aside, you can lock that in. What you're going to have is reinvestment risk. And I think that's what the institutional investors are worried about. The person that's buying Cisco is worried about, okay, I buy short dated paper. Interest rates are 100, 150 basis points lower. When that matures, I've got to reinvest that at a lower interest rate. So, bond math 101, you've got to ladder your portfolios. But as it pertains to tips relative to, take the duration out of it, let's just look at short dated tips versus bills. You've got 5% in a 1-year bill. Think about what a tip is. A tip is real rates plus inflation. You're protected against it. So you could actually generate the same return in a tip, but have upside if inflation goes up. And the real rates above 2% is pretty remarkable. Either the market thinks interest rates are going to go lower or inflation is going to go lower, which is why that real rate piece is the biggest it's been in years. So we think that it's not the most exciting investment, but on a standalone basis, a tip is a good option because you're going to meet a T-bill return, but you've got upside if inflation was to rise. Now, you've got a little bit of downside if it falls, but expectations are already so low. Fed's targets 2, inflation's, you're not gonna lose much between that and the real rate. We think that tips are a good place to be. Caveat being that you're not going to make money. You're just going to, you're going to protect your capital from higher inflation and make a little bit of money, which is, essentially what a bond is. But you've got that upside piece. So we think short dated tips are pretty reasonable, particularly given the higher real rates that are embedded in the tip.
And then when you say short term, you're talking about 2 year, 1 year, 5 year.
I think short term. In my view, anything beyond 2 years, you have to really think about what your expectations are for a shift in the curve, but also, risk.
And of course, you got the credit of the U.S. Treasury behind it. So that
knock on wood.
Knock on wood. Yeah, I know. I think that's important. So you can offset a tip with variable rate Treasury paper as well, right? It's all, as you were saying, it's all part of an overall basket or strategy. But with the tips, with inflation, you'll see the price go higher likely versus the bond portfolio that might go down. So it's effectively a hedge against, maybe stagflation or more inflation, which, as you were pointing out, is something very challenging to harness and pull back. You started talking a little bit about the strategy behind the fund. Walk us through the different instruments and how they're constructed within the context of the fund, just from a strategic standpoint.
So we've got a dartboard, and we blindfold each other, and we just throw darts at the board, and wherever it lands. As I said, we were worried about inflation, how to hedge it. We built up big positions at the firm in inflation swaps, and we started to think about how to construct a more comprehensive inflation protection strategy. And I think we came up with a really unique solution that we believe in, and that's actually worked really, really well. We talked a little bit about the ramifications and permutations of higher inflation, potential economic shock, higher interest rates. So we try to think about the different things that could happen, and we came away with this: if inflation rises, the Fed's going to raise interest rates. So if you want to protect against those two pieces, you need to incorporate inflation and interest rate protection. So what we did was we took that inflation swap, that inflation derivative that I mentioned earlier, and we married that to an interest rate swaption, which is, it sounds complicated. What we own is a 2-year pair swaptions on 5-year rates. Essentially, it's just a call option on higher rates. So you're looking where the 5 years is going to be 2 years from now. It's a derivative where you can take or pay. So if rates go up, you're going to make one decision. If they go down, you're another. But it's essentially a call option on higher interest rates, structured. And I use the call option analogy because your risk is just the premium you pay for that option. So that's all you can lose. So we said inflation swaps are going to give you a return between that fixed and floating spread of inflation and protect you if inflation goes up. So you can earn money definitively from inflation running higher than the Fed's targets and the risk that inflation goes up. marry that with the swaption piece that says, hey, if the Fed raises interest rates, I've got this call option embedded too, so I can make money on higher rates and make money on inflation. And much like this is an ETF, we put this in an ETF, but much like a traditional CTA works, the collateral for a derivative is pretty low, 10%. So like what a CTA managed future fund will do, you just take all that excess cash and put it in bills. We said, well, this is an inflation product. To your earlier point, let's just own 2-year tips as a better option than bills in that inflation context. So those are the three pieces of the inflation swap, the interest rate swaption, and then cash in the tip. And I think it's a really unique mix of what we've seen. So we launched this fund actually with $10 million of our own capital back in July of 22. And it's done exactly what we expected it to do. It's not it's a 10-vol product. It's not a 50-vol product. But it's that even in the last almost 2 years, it's an interesting environment where inflation's actually fallen, but inflation's still running above the Fed's targets. So the inflation swaps have actually made money as inflation's fallen. And you look at, if I could show you a graph of the return, it's interesting. There's been periods where inflation has spiked, and that's driven performance for the ETF. And there's also been periods like last September where it was not inflation, it was a big move in interest rates that generated the return from the swaption piece, from the interest rate piece. So over time, we use the ag as a proxy. The duration's a little bit longer, but thinking what people would marry a product like this to, and it would be a bond portfolio. The ag's up 1.2% since we launched this product with interest rate and inflation bouts like September of 23, like January of 24. Our product's up over 6% over the same time period. So it's really, it's done what we wanted to do. And it's interesting. As I said, it's a 9-vol product, bond-like returns, but the alpha, the engine for the returns is the complete antithesis of what it would be in bonds. If I own bonds, I want lower interest rates, and I want lower inflation, and I want a strong economy. With our product, nobody wants it, but higher interest rates, higher inflation, and really no credit risk. There is no credit risk in the piece. So everything that you're worried about in a traditional bond is not only is it not in this product, but it's going to be what generates the return. So we think it's a really interesting mix. We like the old Razor commercial. We liked it so much we bought the company. We liked it so much we put our own money into the strategy.
Yeah. So I mean, historically, since the launch of the product, when the bond market has zagged, this product zigged, and it's gone kind of the opposite. So it's provided a wonderful hedge, which is what you thought it would do, right? And obviously past performance, you got to disclose that away. But so talk to us a little bit about how big the market is for swaptions and the derivatives that you're involved with.
Yeah, it's a great question. Huge. These are some of the most liquid markets in the world. As I said, we as a firm, we own $300 million in inflation swaps. I could call Morgan Stanley and sell, 50 million of them on a phone call. So very liquid, clear derivative markets. Basically, what we're trading treasuries, treasury options, and tips. So lots of embedded liquidity. And actually, when we first designed the product, what we thought that the use case would be for us to go to, like we do for our institutional clients, go to a pension fund and say, here's an inflation solution. You've got a $10 billion endowment. efficient frontier theory 101. If you look at the DVO1 of your bond portfolio, how do you, what sort of hedge do you want to put on that from an inflation perspective? Okay, we think that, this should be $150 million package of, $60 million in inflation swaps, $30 million in swaptions on a notional basis, and then tips. So yeah, the scale is, we don't own small cap equities. These are the most liquid markets in the world.
Yeah. So somebody in your institutional business, somebody might come to you and say, listen, I've got a $500 million portfolio of bonds. I don't believe that inflation's a problem, but I could be wrong. Well, what happens if inflation spikes 5% or whatever percentage might be? You run a scenario around that hypothetical, and then you can fit this kind of product around that hypothetical as a hedge.
Right. Exactly. Yeah, you think about what the trigger points. You nailed it. Okay, I've got a $500 million portfolio that's a 6-year duration, and it's CLOs and corporate bonds and treasury. So, what does that look like together? And how much do I want to protect against for those different moves? And the nice thing about this product is I think product the same
strategy, really. Yeah.
Strategy is going to be an ETF or standalone, is that most hedging solutions cost you money. You buy options on the VIX and it goes down, you lose money. You buy CDS on the corporate credit market, there's decay or losses. This is a product that we think can generate and has generated a positive return in of itself. So, it works as a hedge, but it's not going to, unless interest rates go to zero, and the economy comes to a grinding halt, it should be something that, it is going to be modestly accretive to materially accretive to your portfolio, which I think is kind of neat.
And it pays a dividend too.
Yeah, I should. In the ETF, what we do is whatever we earn on a monthly basis from the tips, P&L from the swaptions or the swaps, we just pay out every month. And it's not one of these things where it's a return of capital. We pay someone. I think that's something we could go down another rabbit hole, but I think that's frankly a mistake that investors make on the income side, whether it's a closed-end fund or a buy-right fund. They see this distribution, like, oh, this is a 9% distribution. Well, it's a closed-end fund that's distributing more than it yields. All you're doing is getting your own capital back. So it's a little disingenuous for us. So the return's going to be, if you look, it's going to be lumpy. If inflation, if CPI prints January CPI, if it prints higher than expected, the dividend's going to be a little bit higher than it was in December, but we're unequivocally just going to pay out whatever we earn on a monthly basis.
But you're not taking big duration risk with this strategy.
No, on purpose. So there's none in the swaps or the swaptions. In the tips, it's 0 to 2 years, and we rebalance every 6 months to make sure that it's there. And I think there's some products out there that have really hurt people in the inflation space where, it's the unintended risks and the risk of an inverted curve. No one talked about that. What happens if the curve inverts? And I think you want to be, or the comment I made about owning long dated tips and getting hurt by duration when you thought you're buying an inflation product. We don't want to take duration risk. We want to limit duration or mitigate it, actually.
Yeah. So when you're talking about the swaptions, what are the other firms that are involved in this market? I mean, I think you mentioned Morgan Stanley as an example, but there are a lot of other big banks.
Yeah, whoever you need and look, the fees on this fund are 70 basis points because, we're not doing an inverse of Kathy Wood's ARC fund or an inverse of Tesla. It's a product that, you've got to have an ISDA in place with a prime. It's pretty expensive to do all that. And the plumbing is, the plumbing's complicated, but once in place, all the big, Morgan Stanley, Goldman Sachs, Bank of America, all the big, institutional firms that we have, that we have counterparty relationships with, we can trade. And that's the thing about a clear derivative, not to get too far down the weeds, but if I do a one-off OTC derivative with the derivative desk at Goldman Sachs, tied to some theme, the only person I can trade that with is Goldman Sachs, that they structured that derivative. A clear derivative, I can buy an inflation swap or a swaption from Goldman and sell it to Morgan Stanley. I can get that market on from any of my service providers, my pricing sources. It's just a question of who I trade with, as long as I have an ISDA with them. But that
so you see, you were talking about the variability of the swaps. Does that mean somebody else is getting it wrong if you're getting it right?
Yeah. Yes and no. The banks hedge it. It's like here's an example. If I'm going to go way afield with you, but NVIDIA, it reported earnings last night, right? The implied earnings move for NVIDIA was 11%. That's where the banks were pricing that option, and they're just looking to hedge any moves beyond that. So for our product, they'll hedge it, so it's not like the other side. The other side of an inflation swap, Morgan Stanley's got a basket of hedges that could include, everything from interest rates to, believe it or not, energy exposure. But the banks are hedging all that exposure. They're not taking the other side of that trade. And this called, in the equity market, you see it. They talk about gamma adjustments. A stock has a big move. It creates buying from everybody that's got a position, all the options market makers, so they can stay in line with 0-day options or NVIDIA or whatever it is. But the same, it's not like somebody's just taking the other side of the trade. It's the 5-year inflation. It's an actual number. If you look at the 5-year inflation expectation is 2.42. If there's a hot CPI print, it's going to go, could go to 3, but it's a real market that people trade and hedge.
Let's talk about what can go wrong a bit and drive inflation higher. I mean, we don't have control over the price of energy for sure. That's always a risk of things popping, right? Food is also a risk with the supply channel. What are the things that would lead to a spike in inflation in your mind?
Well, I think it cynically, there's a lot of measures for inflation. I think the average consumer would agree that some of the measures that are utilized are silly. If I'm looking at inflation X food and energy, if I'm a consumer, the biggest impact for me is food and energy. So it's a little silly, but the Fed likes to look at PC, or they like to look at super core. That I think the components there that they're very focused on right now are wages and services inflation. And I saw, I can't remember who it was, might have been Bank of America might have been Bank of America. It was this really interesting it was a heat map of the drivers of inflation, and something like a lot of the pandemic pressures have fallen, but wages and services now are a big, and that's what Barkin was talking about. That's a real piece, and that's what rose in January. That got the forward curve on rates to shift pretty dramatically. So it's that wages and services piece that people are worried about. energy prices have stayed pretty low, surprisingly. I think that's something to watch. And it's interesting, the correlation between inflation swaps, like 5-year inflation expectations, and energy. Even though energy is not in CPI, the correlation is really high. Energy spiked in September, and expectations flagged. So you've got, the supply chain stuff. It's real. I sort of discount that a little bit, not to be glib, because I think it will get corrected. But wages and services are, the economy's not slowing. It's not slowing down. It's hard to get that next mile when the economy's strong.
And I know I can make a case that commercial real estate has problems, but other real estate doesn't seem to have problems, right? So rent might go higher.
Yeah, rent's a lot of people feel like rent was a lagging indicator, where you looked at coming into last year, the end of last year, where the indices were still calling higher rent, but rent, in real terms had fallen because it's backward looking. But that's tied to interest rates too, in a way, right? If there's no supply in housing, which is still an issue even 3 years after the pandemic, look at Toll Brothers yesterday. I can't buy a house and because there's no houses, and I can't get a mortgage because interest rates are so high. Not just on the long end, on the across. It's not like you go 10 years ago. The solution was you buy an adjustable with a teaser rate and cross your fingers. You can't even do that now. So I think just simplistically, interest rates and their impact on buyers are going to keep rents high. And I'm not an expert on the drivers of inflation, but I just try to think about, real guy in the street. That's a real that's a real factor.
Well, there's a shortage of housing. I mean, where you live, there is, right? So will rents go down very much? Probably not. Will they go up? Maybe, and that'll drive inflation potentially, right? I definitely don't see anybody raising their hands and saying, I want to get paid less, right? So that's still putting a floor on inflation. I see commodities being a problem, and they can spike up any time, right?
Yeah, right. Well, but I think wages too. If you're, again, if you talk to the average person, they're frustrated that, the Fed's saying, hey, maybe the job's done. And, as we said, they're still, what they're buying costs more. So they want more money. I think wages is a piece that not even is underappreciated. A lot of the Fed governors that's where the trepidation is coming from. One of the areas of trepidation is that, the wage pressure is going to be a factor because the cost of goods and services continues to go up. It's it's an issue. And I think that we started the conversation, Dan, about, and this is again our view internally, that once the genie's out of the bottle, it's hard to put the genie back in. The Nikkei hit an all-time high today. It took 30 years to do it, and they spent a lot of time. They spent decades trying to promote inflation with little success. So it's hard to get inflation, and it's hard to stop it. But the wages and services, and I think we all see it. Stuff just costs. It just costs more, and it keeps costing more. It seems like
the employment market is tight. There's no question about that, right? So people can find out more about your firm at ioniccapital.com.
Yeah.
They can
we've got a website for the product too. CPII is the name of the ETF version of the strategy, and you can get a fact sheet for the fund and some other information, and certainly reach out to us if we wanted to talk about it. But yeah, we think we got a product that really works and we really believe in. Frankly, we're a little surprised that the uptake hasn't been as strong given the not just the performance, but there's no basis risk to the product. It's done what it's supposed. The strategy works. We really believe in it.
Yeah. So you can find out more about the ETF at cpiietf.com. Definitely connect with Doug on LinkedIn. We've got that connection in the chat if you want to find him and ask him further questions. And Doug, thanks very much. Do appreciate the time. Look forward to more conversations. Appreciate your support in the ETF Think Tank.
Thanks, Dan. Thanks, everybody, for taking the time. Have a great day.
Bye. Bye.